Hey everybody, I'm John VanDuzer, CPA and partner with James Moore and Company, and I'm part of our real estate services team. And I'm here today with Dave McGuire, shareholder of McGuire Sponsel. McGuire Sponsel is a specialty tax firm, and Dave is an expert on cost segregation studies. So we're continuing our three-part series on cost segregation studies. So if you haven't caught the other two videos, definitely check those out. And Dave, we're going to talk about, you do a cost segregation study, but the tax code isn't a vacuum, right? In any given transaction or any sort of thing that you plan, you have to consider where multiple tax codes and multiple tax provisions kind of intersect. And so wanted to look at where cost segregation kind of fits in the big picture, not just the nitty gritty on what can be reclassified. So the first one, and we've alluded to it a lot during our videos, is the CARES Act corrected the technical glitch around qualified improvement property. So what benefit or what did that have to do with cost segregations? And I think specifically, the opportunity to go back and do a cost segregation on a property that had qualified improvement property maybe placed in 2018 that for whatever reason wasn't reclassified at the time as qualified improvement property.
Yeah. Well, I think first defining what qualified improvement property is and why that was an issue under the TCJ or the Tax Cuts and Jobs Act is qualified improvement property is an area of property. It's non-structural improvements to the interior of a building placed in service after the building's placed in service. So what I mean by that is if you think of a building as a box, anything that's just inside that box. So it could be drywall, it could be lighting, it could be things like that. That qualifies as non-structural improvements. And it has to be non-residential. So an apartment complex, that's out. But it has to be done after the building's placed in service. Anything on the outside of the box, that includes an air conditioner system sitting on the roof or something next to it, or even the box itself. So windows, exterior walls, that kind of thing, that's not going to qualify. But anything else, what happened is there was a glitch under the Tax Cuts and Jobs Act where they put that in a 39-year life. And that was because qualified improvement property was part of originally under the PATH Act of 2015, and it was a 39-year lived asset, and they just carried that definition over and they forgot to change it. And so what they did under the CARES Act is they switched it to be a 15-year lived asset, which makes all of that eligible for bonus. And then there was Revenue Procedure 2020-25, which came out, which told us how to fix it. And what happens is we have an option as how to fix it. In certain cases, let's say we did it in 2019 and we're in 2020, it's considered an accounting method. So most cases, you're going to establish an accounting method after 2 consecutive years on an incorrect method of accounting. Well, that means in 2019, we could, in theory, go back and amend 2019 to fix those. However, we also have the option of filing a 3115 and pulling it into 2020 and getting a catch-up adjustment. Right. The other key thing to point out there is under Revenue Procedure 2020-25, it is considered a incorrect method of accounting to leave it in 39. What that means is the IRS isn't really saying you have the option of fixing it. They're saying you have to fix it or you get in that weird allowable situation, which I've never seen the IRS really push hard, but it is something you do need to be aware of if you've got this type of property in your system.
Right. So you can basically almost choose the timing, though, on when that deduction takes place, right? So if you put it in service in 2019 before the CARES Act was passed and you went ahead and got it done and you have a 39-year life, you can say, well, do I want to amend 2019 and take that benefit in 2019? Do I want to file a change of accounting method in 2020 and take that deduction in 2020? So you have options there as far as that timing of when you take that.
Yeah, or potentially even hold on to it for 2021 if you wanted to. But at this point, I wouldn't recommend that, probably partially because probably what we're going to talk about next with some of the other changes under the CARES Act.
Yeah.
With the NOLs.
Yeah, well, let's jump right into that since you brought that up. So the NOLs under the CARES Act. So under the CARES Act, they wanted to stimulate the economy. A quick way to do that is if anybody has losses, and invariably in 2020, there will be a subsegment of the economy that will have pretty significant losses. You're allowed to carry those losses back 5 years. And if you paid taxes in the 5 years leading up to 2020 and 2019, you can rebate the taxes that you paid in those previous years, and you use the losses to do that. And it's called a net operating loss carryback. So one of the neat things about a cost segregation study, even if you had a building that you put into service in 2017, for instance, and you said, okay, land is X number of percentage and building is Y percentage, and we're good to go, looking hard at that catch up that you can do on depreciation for the cost segregation study, because that can have huge impacts, especially when you can take that money, carry it back, and generate cash with that.
Yeah. Yeah. I mean, you look at it and let's say we put a building in service in 18 and we didn't do a cost seg study on it. And let's just say it was a $10 million building, just for sake of an example, and we could have moved 20% of it, or $2 million, to shorter lives. Mm-hmm. Well, we've been depreciating that over the last 2 years on a 39-year life. So I'm gonna quicken the math because I can't do the math in my head. But if that was, let's say it was 40 years instead, and we did a year and a half, that means we would have taken $75,000 worth of depreciation, but we could have taken that full $2 million. That means we get a catch-up adjustment in 2020 of $1.925 million. Mm-hmm. That then, if we were in a loss position, that's going to create a loss of almost $2 million, which, as you explained, then you carry back. So you carry it back to the earliest possible year. So that's 2015. Well, 2015, let's say I'm a corporate taxpayer. Let's say I'm not a partnership, I'm a corporate taxpayer. Well, that's back when we had a 35% corporate tax rate, not the 21% we have after the Tax Cuts and Jobs Act. So in theory, I'm carrying it back to a year where I might have actually had a higher corporate tax rate anyways. So right. It helps also balance some of those things with, right now, people being concerned that with a new presidential administration, are we going to see an increase in tax rates? Well, this helps balance some of that concern as well. And it gets cash right into the system quickly.
Yeah, and James Moore has done webinars and videos on, the impacts of the election and the Democratic tax plan. And, one thing I've noticed is I haven't seen any real changes to depreciation or any of the rules around depreciation or anything, short of, the only thing really is the like-kind exchanges. So this still is going to remain a very valid strategy, if not more valuable, as, rates are inevitably going to go up and deductions and benefits are going to be taken away.
Yeah, no, I mean, this has been probably one of the most stable parts of the tax code. I've been doing it for 22, 23 years now. And really, other than how much bonus depreciation do we get? I mean, bonus depreciation we've talked about in the last couple of videos. That's something that started after 9/11 as a way to stimulate the economy back in 2001 for 2002. Other than that, it started at 30%, went up to 50%, went to 100%, back down a little bit, and now it's at 100%. Other than those minor changes, the fundamentals behind depreciation really haven't changed in 20 plus years, and I don't see them changing. Really, all we see is, do they put accelerants on it, like bonus depreciation, in the times where the economy needs it? So right now we're at 100%. I know there have been some Republican proposals to make 100% bonus permanent. I don't see that happening. I'd love it to happen, and I hate to be a wet blanket. I don't see that happening in a permanent setting, mainly because it wouldn't pass the 5-year budgetary restrictions that they have. That's why we normally see it just over a short-term window. And there might be some, I do see that there might be some energy credits that get renewed, but whether it be 179D or pushing for more solar credits or wind credits, if they really start pushing some of the green policies, if the new administration gets their way. But in terms of the depreciation, that's not going anywhere anytime soon.
Yeah, well, that's great. So you mentioned 179D. So that's another one. And this is a question that I kind of encountered in the last few months and I was curious about. So just real quick, what is the 179D deduction? And then how does that impact if for instance, you have a hotel and you build a hotel, mm-hmm. And you do a cost segregation study, but then also want to consider whether or not to take the 179D deduction?
Yeah. So the 179D deduction was part of the Energy Policy Act of 2005 originally. So that was it. So you'll hear it called EPAC, the EPAC tax credit. It's not a tax credit; it's a deduction. I don't call it a credit, but I know people hear about it as one. But It's a deduction of up to $1.80 a square foot for the installation of energy efficient improvements to buildings, and it's split between the lighting system, the building envelope, and the mechanical system. And what happens is you get to write off, similar to bonus depreciation, up to $1.80 a square foot. So in your example, you build a hotel. Say it's a 50,000 square foot hotel. You pay $100 a square foot for it, so you put $5 million into this hotel. You do a cost segregation study, you move $1 million to short lives, you bonus that out. This potentially would be another $90,000 in deductions on top of that you could take. Now that's if you built it from scratch. Where you've got to watch out for 179D, and you have to make sure you're talking to your tax advisor, is on renovations. Because we talked about that qualified improvement property. So let's say lighting replacements. Lighting replacements make something eligible for 179D, but if you're already taking QIP on the lights, you don't want to pay somebody to do a 179D study because you're already writing off the basis there. The other thing is, one thing that we haven't talked about in any of these presentations is the increase to Section 179, which is separate than 179D, although they're very similar. They're separate. The increase to 179 under the TCJA, or the Tax Cuts and Jobs Act, was increased to $1 million, but expanded to include HVAC replacements, roof replacements, and qualified improvement property and some other things, which means if you're doing this as a renovation, don't pay for a 179D study until you've talked to your accountant to see if you've already taken 179 and written these assets off. Because
Right.
you can't deduct something twice. You can only get your basis in that asset down to zero.
No, and that makes perfect sense. So to switch gears a little bit, I think like-kind exchanges have been kind of a hot button issue in 2020. In fact, I think your firm is doing a webinar around the same time that we're filming this video. So kind of wanted a quick, explanation on what that interplay is between a cost segregation study and how does that impact your ability to do a like-kind exchange of that property down the road.
Yeah. So the key thing is with 1031 or LKEs is they changed it under the Tax Cuts and Jobs Act, and starting 1/1/18, you can only do a like-kind exchange for real property. And a lot of people didn't realize it, but before the Tax Cuts and Jobs Act, in certain limited circumstances, you could do a like-kind exchange on personal property. It was limited in its scope. You had to match it up almost exactly, but you could do it. Well, with the expansion of bonus depreciation, they've gotten rid of that. With part of the idea is you get to bonus out your personal property now, so you don't need to worry about it. And so what they did is they changed it and said you can only do a like-kind exchange on real property. So that led to some confusion. Well, how can I do a cost segregation study where I'm maximizing my personal property and still do a like-kind exchange where on a like-kind exchange, I want it all to be real property? And the answer is you almost separate it and think of a real estate transaction as two separate assets. So if I buy a building for $5 million and I do a cost seg study and find $1 million worth of personal property, think of that as $1 million worth of personal property and a $4 million building. Then after a couple of years, I sell that building for $6 million. I'm selling, assuming my personal property is still worth the same amount, so I'm selling that $1 million worth of personal property and a $5 million building. I do a like-kind exchange into an $8 million building. I do a cost segregation study on that and find $1.6 million of personal and $6.4 million of real property. I still meet my like-kind exchange criteria, but the bonus depreciation on my new building offsets the recapture penalty that I have to pay on my personal property on my old. So in that scenario I just ran through, if assuming that all those transactions happened in a 2-year basis, I would have gotten $2.6 million worth of bonus depreciation and paid a recapture penalty on my 1245 property of $1 million. So I'd end up about $1.6 million ahead in deductions. Right. And so it's important to understand how those line up. Now there's little things with that. You've got to worry about tax years lining up, because with a 1031 exchange, you've got a little bit of time to do the investment. You worry about tax years lining up, and you have to worry about state ramifications. Obviously, state ramifications of bonus are critical, and other things. There are other things that you got to take into consideration, but it allows you to almost supercharge both. Because remember, a 1031 exchange is getting out of gain, but a cost segregation study is getting out of ordinary income. And so you want to balance both, because you don't want to pay ordinary income, as you're operating the buildings, but then you also don't want to pay gain when you sell the building. So if you can bundle them together, you can really limit those interactions and get out of both.
Yeah. So a lot of people don't realize when you do a like kind of exchange property, you have to bifurcate qualifying and non-qualifying property, right? And so you have an allocation of proceeds to each. So in the case of a cost segregation study, what is peeled out as personal property in a cost segregation study becomes non-qualifying property, right? So basically, you have this sale of these two separate assets, one real property that you can exchange, and then one that's personal property that you can't. So you end up recognizing the gain. But what Dave is saying is you can still reinvest the extra proceeds from the non-qualifying property. You can still lever up, do another cost segregation study, and double down. And provided everything works out with timing and values and everything else, get that deduction, which can be used to offset that income that you're going to have to recognize. So it ends up, carrying it forward, even though it doesn't technically fall under that like kind of exchange umbrella. You think that's a fair?
Yeah. Yeah, exactly. And there is that 15% incidental, and that's really for the ability for everything to flow through. People get really tied up on this 15% incidental. That's really so that you could flow everything through the transaction. That's not recognizing gain. And so, but the key thing is just making sure you understand all of it can really add up quickly the benefit if you know how to double down and do both at the same time.
Mm-hmm. No, that's great. So the last one, and we talked about this briefly, as we were getting ready for this video, is the opportunity zones. So how does a cost segregation kind of interplay with an opportunity zone, an opportunity fund?
Yeah. So I'm sure you've talked about in some of your other videos, the qualified opportunity zone, that was just a way to get money into historically distressed communities. And the way it works is you invest gain into that area, and there's a tax advantage. You basically get to defer that paying on that gain till 12/31/2026, and you might have a little bit of a reduction, but you do have a tax bill due in 2026. The issue with a cost segregation is that gain deferral offsets basis until 2026. And so in the case, let's say I have $1 million in gain. If I invest that in a qualified opportunity fund that goes out and buys a $500,000 building and does $500,000 worth of renovation, so I've only got $1 million in investment in there, $500,000 in purchase, $500,000 in renovation, then I'm offsetting my entire basis with my gain deferral. So I've got no depreciable basis, so there's no point in doing a cost segregation study. However, if I have $1 million in gain deferral and I invest that into a qualified opportunity fund that buys a $1 million building, then leverages against it to take a $2 million loan out to do $2 million worth of renovation, now all of a sudden I have $2 million worth of basis that I can do my cost segregation study on. But it's important that we look at where that basis is to make sure that there's a benefit there as we do all these things. Otherwise, there's no point. If there's no basis, there's no point in doing a cost seg study. So we need to make sure that we've got basis through that qualified opportunity fund.
And that's a theme with everything, right? No basis, no point in doing the cost seg. So I think that's a good way.
Exactly.
Right. So, well, thank you, Dave. I really appreciate you, giving us your time and kind of going through all these intricacies. Like I said, I think you're just a tremendous resource and the person I go to when I have a lot of really deep technical depreciation questions. And so really appreciate you being willing to do this and definitely recommend you as our cost segregation study provider anytime it makes sense in all of our planning. So thank you. I appreciate it.
Well, thank you.
Be sure to check out our other videos. So we do plenty of videos around real estate, and you can see them on our website, www.jmco.com.